On June 5, 2026, the Nasdaq Composite plummeted 1,121 points, recording its worst single-day point drop in history. Simultaneously, the S&P 500 erased $1.8 trillion in market value, ending a 9-week winning streak. The damage was highly concentrated. The Philadelphia Semiconductor Index fell 10.3%, wiping out $1.3 trillion from the semiconductor sector in a single session and marking a violent reversal in AI momentum. The macro trigger for this sell-off presented a paradox. The U.S. economy was actually adding jobs faster than anticipated. May non-farm payrolls came in at 172,000, more than double the consensus expectation of 80,000 to 85,000. The unemployment rate held steady at 4.3%. A robust labor market typically signals economic health, but in an inflation-sensitive environment, it signaled persistent price pressure, instantly erasing institutional expectations for near-term Federal Reserve rate cuts. The underlying artificial intelligence technology did not suddenly fail on June 5th. This crash was a crisis of market microstructure and systemic fragility. To understand the velocity of the decline, we have to examine the exact point where macroeconomic rate shocks collided with severely overcrowded tech positioning, a massive primary market liquidity drain, and negative gamma hedging. The June 2026 crash requires looking past surface-level economic data to dissect how modern, passive-heavy, options-driven markets behave under sudden structural stress. The immediate reaction to the May jobs data surfaced in the bond market, pushing the 10-year U.S. Treasury yield above 4.5%. This discounted cash flow scale model illustrates duration risk. When the risk-free rate rises, the discount rate applied to future earnings increases. For long-duration AI assets dependent on cash flows years in the future, a higher-for-longer cost of capital mathematically compresses their present valuation. This immediate rate shock arrived during a major leadership transition at the Federal Reserve. The market was already adapting as incoming chair Kevin Warsh took over from Jerome Powell, bringing a different operational philosophy to the central bank. Warsh has signaled an intent to eliminate the quarterly dot plot of rate projections and significantly reduce forward guidance, returning the Fed to a meeting-by-meeting approach driven by incoming data. This shift toward communication opacity clashed with renewed supply shocks. Direct military exchanges in the Middle East drove an 84%. This S&P 500 market cap concentration chart shows how, prior to June 5th, the index's record highs were driven almost entirely by a remarkably narrow basket of mega-cap AI and semiconductor winners. These valuations had priced in flawless execution, high margins, and infinite demand growth. The micro-catalyst arrived when Broadcom released its third-quarter AI chip sales guidance. They projected $16 billion, missing Wall Street's $17.2 billion expectation. This guidance shortfall punctured the belief that artificial intelligence capital spending was entirely bulletproof, triggering a disproportionately violent, disorderly sell-off across the entire semiconductor sector. The AI trade had evolved from a fear of missing out into an overcrowded momentum play, heavily reliant on leverage and retail participation. In a severely overcrowded, long-duration trade, good earnings are no longer sufficient. Any failure to clear sky-high expectations inevitably triggers a stampede to the exits. Compounding the macro and micro pressures was an incoming primary market liquidity black hole, the SpaceX mega IPO. The offering sought to raise $75 billion at a valuation between $1.75 and $2 trillion, instantly making it one of the largest companies in the world. This capital flow diagram illustrates Nasdaq's fast entry rules. Top 40 market cap companies can now achieve index inclusion in 15 days. This creates massive forced buying pressure. Passive funds tracking the Nasdaq 100 must mechanically liquidate existing AI constituents to absorb this new float. The sheer gravity of the SpaceX listing and the fast-track indexing rules effectively cannibalize the secondary market liquidity of the very AI sector that paved the way for it. This model plots index price against dealer gamma exposure. Normally, market makers in a positive gamma regime act as structural shock absorbers. On June 5th, plunging prices pushed dealers into a negative gamma zone, algorithmically forcing them to short futures, violently accelerating the drop. This algorithmic, price-agnostic selling stripped the market of its liquidity buffers, turning a fundamental tech correction into an uncontrollable, self-reinforcing liquidation cascade. The June 5th crash fractured Wall Street consensus into two polarized institutional camps. Citigroup's strategy team, led by David Chu, issued a highly defensive thesis, warning that the post-crash rebound is a systemic bull trap. They noted that short sellers are aggressively building new positions, while the overcrowded tech long positions have not yet fully unwound. This structural imbalance leaves the market highly vulnerable to further shocks ahead of imminent risk events, including the first rate decision under Fed Chair Warsh and the upcoming CPI print. Conversely, Goldman Sachs maintained a structural AI growth thesis, viewing the crash as a necessary and healthy technical clearing event. Goldman upgraded their year-end S&P 500 target to 8,000, anchored by projections for 24% earnings growth in 2026, driven by concrete AI infrastructure deployment. Sophisticated investors are now navigating a complex macro reality defined by monetary policy opacity, geopolitical inflation shocks, and severe microstructure volatility. Traditional benchmark 60/40 portfolios are dangerously undiversified for a volatility regime heavily skewed by tech concentration and options mechanics. Institutional mandates are now exploring defensive sector rotation, diversifying out of concentrated indices, and utilizing real assets or commodities to hedge against inflation and supply chain risks. Navigating the post-June 5th landscape requires moving beyond simple fundamental narratives to actively map and manage systemic, structural market risks. Please note, this analysis is for academic and informational purposes only and does not constitute financial advice.